So how was your approach as a VC different from the other VC?
My first investment was a company called Vitify. What it taught me was that in the early stage, it's really just about the quality of the founder. And I invested into a couple of more startups. Few of them failed, did not work out for a variety of reasons. It gave me also, lessons to me as an investor as to what is the right thing to do. You are investing as an angel, it is your own money, right? But when you're investing as a VC, it is not your own money.
So when you transitioned to VC with Werize, A, how was the experience? B, how did it affect your mindset in terms of looking at startups, looking at the ecosystem? If you could share some insights on that.
Yeah, so Shawrya, I was doing some angel investing, since 2016. As I stepped out of the corporate world, stopped being an operator, so to speak. Although, still I was very much an operator inside, still am. I started to see, there was a difference in being an angel investor. The second time, and this was my second entry into the tech startup ecosystem, and that too as an investor. In my first experience, I was really part of the founding team at India.com out there in Bangalore. And this for me was my first time. So I took it as a two-step journey into venture capital. I first started to invest in startups as an angel investor. My first investment was a company called Vitify. And Vitify is now transitioned into Stage OTT, a brilliant team of Vinay Singhal and team, and amazing founders. And what it taught me was that in the early stage, it's really just about the quality of the founders. And when you say quality, one of the biggest things that you have to look out for is hunger and resilience. And the two of them are actually, they're two parts of the same coin. If you have the hunger to succeed and to make a successful company, you will have the resilience to go through the ups and downs, like, the Stage OTT guys did as they transitioned from what they started off with, which is very successful, which is Vitify, into Stage OTT. So with some of these learnings, and I invested into a couple of more startups, few of them failed, did not work out for a variety of reasons. It gave me also, lessons to me as an investor as to what is the right thing to do. One should be building a big portfolio of at least 15 to 20 companies, just investing into 5 or 6 companies and then doubling down on a few of them if they are coming up for further rounds, does not make sense. The first thing to do is to build up an adequate enough portfolio and then start to invest a second time round. And these are learnings that I transition into venture capital with. So as I entered venture capital in 2018, I started to make investments at that point of time. My first investment, which I led in 2018 in September, was Beato. Now, Beato is a health tech company focusing on diabetes and the management of diabetes. So Gautam and team, Gautam and Yash and team, they were absolutely, they mesmerized me. They were absolutely, hunger and resilient founders, still are, building Beato from strength to strength. I started to reapply and learn more about what makes a successful investor. But there was actually a difference. When you are investing as an angel, it is your own money, right? But when you are investing as a VC, it is not your own money. I don't know how many people know, and especially your VC fellows, that according to SEBI, only 5 crore rupees or 2.5% of the fund, whichever is lower, can be the contribution from the VC themselves. So the VC firm, which is the manager of the fund, you can imagine that if they fulfill only this much amount of criteria, and most of them are like that, 97.5% of the funds actually belong to others. So these are HNIs, family offices, sovereign funds, both Government of India funds, taxpayer money, like you have with SIDBI or NABARD or now with Self-Reliant India Fund. It creates a huge sense of responsibility you can invest your own money. You have only to answer yourself, why something went right or something didn't quite, go right. But when you're investing as a VC, you have to answer hundreds, of questions from the many people that you owe an answer to, and that's your LPs, as limited partners, as they are called. So that brings a very different sense of responsibility. While the check size becomes bigger, and it's not going out from your pocket, so to speak, but I feel that the burden is much more. The responsibility is far more. And therefore, one has to be, doing the due diligence before investing. Also, really rolling up, sleeves, just like, you see me, I have my sleeves rolled up most of the time. Working very closely with the founders, just building a portfolio. Perhaps as an angel, you can do it, and most angels do it. Perhaps they have some other business, they have some other work, and then they build this as a sort of passion and wealth creation possibility. They don't actively work with the entire portfolio. Many of them have, hundreds of investments, investments running into 50s, and it is humanly not possible to devote time to so many companies. But for a VC, this is their daily bread and butter.
Yeah.
And for a typical, seed stage, early stage firm, which is maybe about 250 to 500 crores, you will end up making a portfolio of about 20 companies. So with, check sizes of maybe, let's say, between 3 to 5 crores as the initial check. What that means is that you have to incredibly work very hard. And it has become increasingly important to work very closely with founders to give them the best chance of success, which is why founders also, I realize, and this was my learning, unlike when they look at angels, when they look at VCs, they look at more than just money.
Right.
Because for angels, it's a passive investment. For founders, it's the initial, sort of seed capital or pre-seed capital. So they're not expecting much from it. But when they're taking a heavy check, and along with it comes all sorts of reserve matters and rights, tag and drag, and lock-in of shares and all those kind of things, and you're giving away a sizable equity, no less than maybe 12 and 24%. Then you're obviously wanting something in addition to the capital, right? And that means that you require active help, active mentoring, and that's something that doesn't come naturally to a lot of VCs. I feel that, they leave it sometimes too loosely to the founders, or they wait for that emergency call, or they're just looking at maybe an MIS. And what I realize that founders, on the other hand, are appreciating if VCs work along with them. So another thing that the VCs, as I realized, my life changed. From being an angel investor, I had to just source and make an investment and then watch it. But as far as VC is concerned, you're also supposed to spend a lot of time post-investment. In fact, there starts a whole new, different, important part of the journey.
Right.
To make that startup successful, to help them fundraise, to help them recruit candidates, to help them navigate regulatory waters. If there is issues between the founders, can you play a role over there? If there is issues between co-investors, can you play a role over there? If there is, issues with partners and things like that, or you just need to be a sounding board sometimes for ideas. When you're stuck somewhere as a founder, you have thought of 3 directions, but you really are not able to decide as to which direction to go. Then VCs can actually be playing that role very actively by being there, giving their time. So one has to therefore also allocate time in the day. One can't be so busy as to spot the next opportunity and sign, a shareholding agreement, transfer the money, and then wait in the wings. Yeah, then wait and watch in the wings, and then keep doing likes and thumbs up, and that's all. And it doesn't end over there for sure, because in a VC's life, the cycle is only complete when you've taken the cash from LPs and returned the cash as and when the fund closes.
Right.
Or at least done a part of that if you had to take it that way. So I think that's why in VCs you have metrics like multiple on invested capital. Of course, you keep an eye on IRR because MOIC by itself means nothing. It is just a trend line that you're going in the right direction. At least it's not negative. And DPI or distribution on paid-in capital is also very important. For example, 40% or 0.4 DPI means that you have returned 40% of the principal that has been invested, by the LPs into these startups. So that's a great joy as well. So so I'm very humbled actually that the transition from an angel to a VC. When you're handling other people's money, it becomes a huge responsibility. And your life changes actually.
So how was your approach as a VC different from the other VCs or other folks who were heading and managing the other VCs in the ecosystem?
Look, everybody has their own personal style, right. But I think one thing that perhaps founders of the folio company is that where I personally led the investments, at least the early stage, I tried my best, guys. So I'll leave that to you. But I was always available to them. I was on their speed dial. I would actively participate in their brainstorms, open new doors, think of new ideas, travel across. Of course, COVID was difficult. But the moment COVID opened, I was always very, very keen to meet them in person. And that I think also helps a lot because not everything can be done on a Zoom call. Right. I think post-COVID, one of the things that has happened is many of us assume that relationships and value addition can take place over a Zoom call. Right. Maybe some limited value addition can still happen over a Zoom call, but it's difficult to form relationships without meeting in person. So there is a value attached in going always to a founder's office and sitting over there and having a chai or a coffee and discussing plans. And founders like that. They welcome that. They want you to come. They don't want to have uninvolved investors who only give a call when they see something in the Excel sheet which they want more details on, or only when the time for fundraise is near because maybe the cash is running out or things like that. So then it is more functional and one has lost out on the opportunity to build relationships. I think that is very important. Yeah.
You talked about looking at hunger and resilience in founders. Do you think that I and Rajan have that? This is just for
I'll say too early.
You looked at hunger and resilience as two things that you look at in founders. So how do you kind of measure that? Because this is not a quantifiable metric per se.
Oh yes, it is not. It is something that is very subjective. However, there is a science to it. Okay. Yeah. I have seen that hunger in founders can be judged in different surrogate ways. And it's a little bit of a secret. I don't know. So this is my assessment style. If you guys, want to use your own style, but I'm letting some secret out. So I look for desire at an early stage to do something which is special and different. Okay. And if that exists in the background of the founders, maybe some leadership qualities, right? Maybe some project that you have done, maybe some leadership position in school and college that you have, maybe something that you're really proud of, right? And if it is corroborated by people around you, and we will do reference checks on that, then that's a great plus. It means that high achievement orientation exists inside the founders. This is not an opportunistic 3-year play because, capital is available and, this place is hot and therefore let's go and, do a startup and let's see, I'm kind of young and, let me spend 2 years dabbling in a startup. It's very cool to be a startup founder. And those are not the reasons what's driving you. The reason is hunger to make something which lasts beyond, even your time. So a name that you can create, a company that you can make, which people look up to, I think that hunger has to be there. So there are telltale signs of these in anyone's past record. The second thing is, resilience. The vulnerability that you have to show that, in your journey, you had some ups and downs, you made some mistakes, you learned from those mistakes, and then you stood up and walked the path again. I think that is something that is definitely valuable. If one hasn't seen adversity, then one can be guaranteed that the ride is not going to be easy at all, because there is not a single industrialist in this country or anywhere else in the world who hasn't faced adversity while building a large company. And if you're building in a space where other people are also building, it's kind of a zero-sum game. Somebody is going to be number one. There can't be two number ones. So who's going to move ahead is going to be dependent a lot on that ability to face adversity. Because once you cross that, your competition is likely to be redefined by how you handle that situation. I also look, by the way, for harmony. So when there is more than one founder, the presentation also reveals the nature of harmony and cohesion between the founders, the body language. Very rarely I have made investments without, or led investments without having met people in person. Even today, when I'm advising some founders at the seed stage, and which we will, have a look at it once the fund is set up, the attempt is to know founders as people, and not just as a resume.
Right.
Now, when you are sitting with each other, how you treat each other, how you behave with each other, the chemistry between you, all of that reveals elements of harmony or the absence of it. Nothing is perfect. There will be disagreements. But how you resolve those disagreements is very, very important in any such partnership that you are, that goes behind founding a company. So it is extremely important that when, tough times happen, adversity strikes, those are the times when relationships and this harmony is tested. So if you're able to have a constructive discussion, if you're able to move ahead in the direction of your goals and not having any need to split up, etc., then that's the sign of harmony in a relationship where both of people have mutual respect, mutual trust, things are fair, transparent, etc. So we see a lot of that in our assessment. So there's a lot of subjectivity. This is, this is not some kind of a, read 3 books and fill up some 5 forms and you will get there, which is why that's what makes VC's life very interesting, also very risky. Right, so it is not something that you can download to anyone to sort of go ahead and start doing from tomorrow. It is very personal, and therefore that also excites me because it can't be replicated. There is a moat inside it.
Do you think numbers really matter a lot for say early stage startups?
Yeah, not really. I wouldn't say that. By early stage, do you mean seed stage?
Yes.
Okay. So at the seed stage, look, there is hardly any numbers. The company has not been operational for like last 5 years or anything. Probably the founders have just left their jobs and within 6 months they've started something and they're sitting in front of you after some experiments, raising some, round from friends and family and they have some early results to show. So at that point of time, it's really about the quality of the founding team and the market opportunity assessment. So that's all. I don't think you can go by the model that they are currently put in front of you to evaluate whether that company is going to be successful, because that model is going to undergo several pivots.
Absolutely.
And by definition, startups are all about something new and disruptive.
Yeah.
So if it hasn't been done before, then it hasn't been perfected before. So it is highly unlikely that you're going to have a perfect plan in front of you and say, well, that's great and that's going to give you the confidence. So I rely on quality of the founding team and the market opportunity assessment.
Fair. So when it comes to raising funds, VCs also raise funds from LPs. Is it tricky? Is it hard? And what do these LPs typically look at when they're investing in a VC?
So fundraising for founders, if you thought that was difficult, I think, just multiply that by many notches up for VCs as well. Yeah, it's raising funds is never easy. Just like founders go to multiple VCs and then they maybe get that yes from one or two, or if you're lucky, maybe more than that. It's no different for VCs raising funds from LPs. LPs also, as this asset class called venture capital, has now become more prevalent and people are more aware. They also have a wide choice. A lot more, funds have come up in India. I think more than 800 funds or something got registered in the country in the last 2 years alone. So the number of LPs that is finite at a point in time. The number of funds having increased, seeing the opportunity over here, everyone is ambitious to raise a fund. It is difficult. I wouldn't say to anyone and be dishonest that, hey, you can start a fund tomorrow and it's going to be very easy. Ring a few people up and you'll get the money is easy. No, it's never like that. Raising funds from LPs is both a science and an art. So the science of sales definitely applies. Not everyone is going to give you a check. You're going to have to build a sales pipeline. And the art actually comes in how you sequence it and how you present yourself. What's the story? What's your thesis? What's your fund model? VCs with a past track record, either as angels or having worked in funds before as employees or partners or managing partners, etc., obviously have a much better chance, and a track record matters a lot in this industry. But increasingly things like transparency, governance, ethics, and I've written about it, in some of my posts on LinkedIn, over the last few months, has become increasingly a differentiator. So the world of VC investing by LPs is also getting more sophisticated. It was a very new asset class 10 years ago, but that's not the case today. LPs like HNIs and family offices also have the choice to hire managers to do direct investments. They have picked up the networks over the last 10 years or so. People from the VC space or from the founder space or investment banking space have also, with utilizing some of these networks, have also moved on to the family office side to manage their direct portfolios. So it's not difficult. It takes at least a year or not, if not more, to help close a fund. Typically, the size of the fund is anywhere between 300 to 500 crores at an early stage. It may be a little smaller if the check sizes are smaller or the stage is a little bit earlier. So one does need to be, constantly at it. It is you start investing at the first close, but the final close may be 12 to 18 months away, by which time the last check into the fund comes in. And LPs are also of various kinds. Typically, sovereign funds and fund of funds don't come in the first close. They normally come in the second and the third close. After you've raised an initial pool of capital. It's almost like how founders, raise some initial funding from their own savings or friends and family to show enough commitment and skin in the game. Similarly, large funds also wait for GPs, of VC firms to raise some initial capital. So to give you an example, in a $75 million fund or a 500 crore fund, I would say a minimum of 50 crores is something that one should raise from, commitments should raise from one's own sort of sources. And these would be typical, HNIs, where according to SEBI rules, the minimum amount is a 1 crore each, or family offices where amounts can vary. So it's a backbreaking effort.
How do you build a compelling story and a strong thesis to be able to raise funds from LPs?
Yeah, good question. So, an undifferentiated fund in a world of so many different funds, especially in today's times when this ecosystem is 10 years down the line, is no fun at all. So, therefore, one needs to have a market opportunity, a unique, compelling proposition. Usually, it depends upon two or three things. One, it could be you have a great track record. So that's quite compelling to
Right.
LPs that look, you have been there. These are the companies that you invested in. This is the IRR that you did. This is the money that went back to the LPs. So that's quite straightforward, and it's very important. If you have it, then you definitely have a leg up. The second part of the thesis is really in terms of the market opportunity assessment. So as you're investing in innovative and disruptive companies, where do you think the market is going to be at? Where are the companies going to be? Which sectors are going to be important? Where is the growth going to happen much faster over fund life than certain other sectors? Quite a few times VCs have identified sectors and invested in them, but it has been too early or too late. And if you miss that rising tide, then the returns are not even half as great as when the when the timing for that tide is been estimated correctly. So to give you an example, look, if you entered let's say climate and sustainability 10 years ago, it would not make a lot of sense.
Right.
Hardly anyone was talking about it. COP28, COP26 goals hadn't come in, nations hadn't pledged, it was not coming through regulatory as well, SEBI guidelines hadn't been issued as well into the future. But 4 years ago, it was a perfect time because all these things had taken place. If one invested in travel, experiences, before the building of the infrastructure that has taken place over the last 10 years, it would not have flown so much.
Right.
But today, if you invest in hospitality, today if you invest in a motel or a highway chain or something, it would do rather well because the infrastructure has been built to a critical extent and it is continuously rising. Similarly, today, drones. If you talked about it 10 years ago and invested in a company over there, you would have to wait patiently by yourself because the business wouldn't be there. But today, these companies are very much in demand, as we've seen in famous weddings as well.
So fund cycles is something that has personally intrigued me, and I've been always very curious to understand why it's 7 to 11 years, why it can not be 15 years or 20 years, 25 years, or maybe why can it not be lesser, say 3 years or 5 years.
Yeah. So good question. Look for the answer is different for different stages.
Okay.
If you're an early stage fund, US data says that it takes about anywhere between 8 to 10 years for most companies to reach a scale by which they can do an IPO satisfactorily.
Okay.
So this data is coming from the US. So typically, Indian VCs have always looked up to Silicon Valley, and this is the driving reason. And therefore, they replicated the same learning over here when we had no examples about 10 years ago to predict how much time it's going to take. We just took that learning and said, okay, let's have an 8-year fund with a 1+1 extension based on 75% approval as per SEBI rules, and let's fashion the fund that way. But if you are looking at a fund, for example, which is a private equity fund, where you are going to identify assets, put in maybe $100 million each, take up, minimum 26% to 51% of a company, and it's a controlled buyout kind of a proposition. You can even have an exit in 5 years.
Right.
So it all depends upon, what kind of fund stage you're at. But at the early stage, that's the real reason why the funds have been kept at 8 years with an extension possible of another 2 years.
So I think we have observed the Indian ecosystem over the last 10 active years of VCs. This 8 to 10 insight that you shared, does this data point stand for the Indian startup ecosystem as well, according to you?
Yeah, again, good question. So the answer is yes and no. Yes, it is close by. funds which were started in 2014, which have now completed the 10-year fund life with extensions, they have yielded some successful companies which can IPO. And many of them have IPO'd as well. So if you look at Zomato, or if you look at, Policy Bazaar, etc., these are products of that. But has a large percentage of them gone to the public markets? No, not really. So my sense is that in India, given that we're an emerging market, the learnings from a developed market like the US were not directly transferable. So one had to add few years. So if you ask me, maybe we should have added, at least 2 more years and allowed a lot more companies to, migrate to the public markets. But now, look, with the infrastructure having built in 800 plus, million mobile phones and, 5G data and, all of that, which is not the case 10 years ago. Today, you can scale a company much faster. So I think today we are in a position to replicate what has happened in the US, and that learning can be now directly applied. Now you can, I think, have that 8+2 works really well. You shouldn't, if the idea is great, if the execution is great, there will be 2 winners in a space or 3 winners. One should not have too much trouble going to an IPO in that much amount of time. So that fund cycle is sufficient now.
So there have been rumors about a lot of international global funds entering the Indian market in the last 2 years, right? Is this true according to you? And if yes, is this what you just shared as an insight which is actually making them come to India?
So there is no doubt. There are 2 things that are happening. One is India is currently the fastest growing economy in the world. Secondly, the relative unattractiveness of any other country in this world, particularly China, which was leading sucking all the investments of the global ecosystem, has made India the best story, to be investing in. Funds and fund managers who were underrepresented or unrepresented in India are now taking a very favorable look towards India. So yes, there is a lot of movement, there is a lot of chatter, there is, every event is full of LPs wanting to take a look and meet up with GPs. So I think there is a lot more action, a lot more representation of the global fund ecosystem that will happen now in India than we have seen in the last 10 years.
So Anup, what's been your favorite investment and why? And also if you could share the kind of metrics that make a startup your favorite investment.
Oh, that's a interesting question. So look, I landed up leading about 16 investments in the last 6 years, excluding some of the angel investments that I did with my alumni-based startups. My most favorite investment will come second, but I think I got incredibly attached to each one of those companies, and therefore all those founders are extremely special. But of course, everyone has a little bit of a favorite. So my favorite has been a company called Batterysmart, and it is my favorite, not just because the quality of the founders, and that is second to none. And actually, all the founders are incredibly brilliant. However, what I really realized is the immense amount of impact, both profit and purpose, that this company has been able to create. And you don't get so many opportunities in a lifetime to be able to make impact. There will be opportunities to make money, and a lot of investors will tell you, whether it's public market investors or private equity or venture capital, that they made tons of money. But the satisfaction that comes with making an impact on people's lives is even greater. And that is why this is incredibly heartening to me. The focus over here was the 2.5 million e-rickshaws that take students, housewives, small businessmen and workers and people of all walks of life to have an affordable ride from their home to the nearest metro station in the morning and back, and also in the middle as they carry about different activities during the day. You guys come from Delhi University campus. You're no strangers to the e-rickshaws between Mukherjee Nagar and all the Delhi University campus. So these are actually the largest fleet of electric vehicles we have in the country, and for the past so many years, and nobody talks about them. And they are powered with lead acid batteries. So when the Batterysmart founders, Pulkit and Sid, I met them, and they said, we're going to retrofit these vehicles with lithium-ion batteries and make it available on a pay-per-use basis. I was completely blown by the whole idea. It was extremely asset-light in terms of, franchise stations being placed at every, corner of the busy traffic routes of these first mile and last mile mobility required by, all citizens. So it had a huge impact on the lives of the migrant drivers and owners of these e-rickshaws who come only to be able to earn a living. So imagine you are able to impact so many lives in one go. The same number of e-rickshaws can be back on the road far more if you have a battery swapping network to support them. Otherwise, after driving for 45 to 50 kilometers, the e-rickshaw driver has no choice but to take his lead acid battery e-rickshaw to the nearest charging point and wait for 4 to 5 hours to charge that e-rickshaw. That's time lost. And that means that you have to do, for the same number of passengers who have to carry about their daily lives, they have to do it on something else, which means that more petrol and more diesel, and it's bad for the planet as well. So not only are you impacting the income of the e-rickshaw driver, you're increasing the supply of electric kilometers in the road, which is great for climate and sustainability. You're setting up one of the cheapest and highest return businesses in the form of a franchise battery swapping station. And you're able to power this entire electric ecosystem, which actually is so unique to India. And they did this starting 2020. Of course, there was COVID. The moment COVID went away, this came on, and it has just been growing phenomenally, year upon year. And it's one of the most valued companies in the climate space today. It has created, I think, triple-digit IRRs, if I'm not mistaken. And they will continue to weave this story with the growth in e-two-wheelers, which has come about since then.
Please tell us more about your portfolio. I mean, how many companies have been able to raise follow-up rounds, and how many of them have shut shop? Okay.
So out of all the early stage investments that I led, and there were 12 of them over the last 5 odd years, 70% of companies have moved beyond the seed stage. 30% couldn't for a few reasons. About 30% of those companies have made it to Series B. Wow. So that's incredibly great of the founders, and I was lucky enough to find them.